One of the most impactful variables that affect car loans are interest rates, which determines the cost of borrowing. Lower rates mean paying less overall in financing. The average car loan rates are around 6% for new cars and 10% for used ones. But that does not tell the whole story because your credit rating affects the interest rate that you can get. Additionally, credit score also affects whether you get approved for a loan and get favorable loan terms. Let's briefly talk about your credit score. It is a 3-digit number that represents your creditworthiness. Lenders use it to assess the risk of lending you money, including car loans. The base FICO scores range from 300 to 850, and a good credit score is above 670. According to Experian, one of the major credit reporting agencies, 67% of Americans have a FICO score that is considered exceptional, very good, or good. If you are in the 33% of people with fair or poor credit score, you need to do extra due diligence to avoid being taken advantage of through bad car loan terms. Now, to make this more confusing, Experian, that provides some industry average information, categorizes credit scores into 5 different groups. Super prime at the very top, then prime, non-prime, subprime, and deep subprime at the bottom. Let's take a look how your credit score impacts the interest rate you can get. Borrowers in the highest group, the super prime credit score above 781, can typically secure car loans with average interest rate of 4.75 for new cars and 5.99 for used vehicles. Now, borrowers with subprime credit scores between 501 to 600 can expect much higher interest rates, averaging at 1079 for new cars and 1746 for used vehicles. So you can see how credit scores significantly affect the interest rate offered to borrowers with lower scores, resulting in higher interest rates. Now, you may have the same question I had. Why the interest rate for used cars are so much higher than for new cars? Aren't these loans and cars more expensive, so have more risk? Well, that is true, but there are also other factors that make the used cars loans more risky. The first one is used cars have already experienced depreciation, which means they are worth less than their original purchase price. There is also a higher probability of mechanical issue or need for repairs. Also, used cars have a lower resale value, so the lenders have a worse chance of recovering their investment in case of default. And finally, car manufacturers and dealerships often offer different financing incentives and low interest rates on new cars to encourage sales. Thanks so much for watching.